Hey everyone, Douglas here, Kenna Market Analysis, and in this video, what I want to do is lay out the kind of the underlying trading strategy that I've built on the fundamentals of modern monetary theory, and show you how I've gone about kind of constructing a trading strategy with those core elements of understanding MMT. And I'm doing this by building upon the last 3 macro-themed updates that I've had on my YouTube channel. So if you would like to watch those and get some better context for where this is coming from, I will both link to them below and put the card up in the corner of the video, and you can see that playlist and watch those last 3 videos. So again, the idea here is let's take a look at kind of the basics of MMT, get an understanding, and then I'll show you how I use that data to really build the core of my trading strategy. Now, to be clear, this is not the entirety of my trading strategy, and this would probably be best implemented from kind of maybe more of a buy and hold standpoint, where if you're kind of a long-term buy and hold style investor and you're really just trying to understand, hey, what might a big recession, a business cycle recession, what might something like that be coming around the corner, and maybe you might make a few tweaks if you had that information. That's probably where this is most going to be beneficial for that style of trader. If you're an active investor, active trader, you're definitely going to want to add some layers to this, something I do with my own trading. You can check out my work over on my Patreon page, patreon.com/KennanMA. If that's you and you want a deeper analysis, check that out over there. But again, this is kind of the base strategy, if you will, and then from there you can add on further analysis and understanding to build a better strategy. So just to kind of set the context in the right space, and just kind of go from there. So let's do this. Let's dive into things. Like I said, I'm building this upon the last handful of updates that I've had, where I looked at essentially the chart that I built in front of here, which shows how funds flow from the federal government, from the Treasury, into the private sector, ultimately into the financial sector. And if you have sufficient flows flowing into the financial sector, is kind of the case I made over the last videos, and I'll demonstrate this more specifically today, you're going to see essentially a growing stock market, a growing equity market ultimately, and you should expect things like sell-offs to be bought quickly. You should expect big bull markets to emerge, and certainly over the last decade or so, when we've had large fiscal spending, large deficits, that has really been the case. Obviously, the last 6 months or so, post the financial crisis following COVID, we've seen a huge surge in the deficit. We're seeing headlines every month about how the deficit continues to reach unprecedented levels, and so it's very little surprise from an MMT perspective if the flows coming from the federal government into the private sector, if that is what that correlation is that they say that it is, then you would expect I use healthy in air quotes here, but a healthy, a growing, and bullish financial sector. Again, I've gone over this in the past, that's not to say that the real economy is healthy. That's a different discussion, for a different day. But for investors, obviously what's most important is the financial sector. So that's what we're really going to break down now from that perspective of MMT, and try and get a trading strategy built out of this. So at the core of MMT is this idea of sectoral balances, right? And it is exactly what I was just showing here in this chart, that funds from the federal government, that's where all money has to start from, right? There's no other place you can get dollars from. If you ever, I don't know if I have any money around me to show you, but if you have a dollar bill on you or whatever, and you look at it, whatever denomination it is in the US, it's going to say on multiple places, the US Treasury. I think there's the Secretary of the Treasury and one other Treasury official whose names are on, signatures are on every single printed currency, because that's where it's coming from. That's where all money has to originate from. Now, granted, money can come from other places endogenously. You can get bank money and that sort of thing, but a bank can't get that capacity to create money unless there is a federal government issuing that in the first place. And that gets shown in this idea of sectoral balances. So what we're seeing here is the red line, okay, is the deficit essentially. That is the government deficit. And then on the complete reverse, the inverse of that is always going to be private sector savings, because essentially by accounting identity, you have to you have to have an opposite. An opposite flow coming from the other end. And so again, the idea here is sectoral balances. You also have, in kind of the classic sectoral balance breakdown, you also have imports minus exports, exports minus imports as essentially a loss of financial assets to overseas. And so if you're interested in getting a little bit more detail about sectoral balances and the entirety of the math, the Wikipedia page over the years has really developed nicely, and there's a lot of good information in here. So check that out. Again, the idea is to look at the flow of funds through an economy from an accounting standpoint and come up with, ultimately come up with as it says right here, a framework for macroeconomic analysis. Essentially the punchline, if you read through this and some of it doesn't make sense, you go down here to the sectoral balance description, and it's going to lay out how you can essentially take the GDP relationship as is derived from the national accounting relationship between aggregate spendings and income. You take that and you do some basic algebra, and you eventually end up with this equation right here, which is going to be savings minus investment. So private sector savings is going to equal government spending or public sector deficit minus taxation plus exports minus imports. So in the U.S. case, that's going to be a negative number. So you got to remove the financial flows coming from that. The main point is there's an accounting identity between private savings and public spending, okay? And that's the most important it's the most important thing to take away for kind of the first piece of information here, first building block that we're going to build from to build up our trading strategy. So what's the implication here? Pretty much the implication is as long as you are getting necessary, what I like to call fiscal flows, and I define fiscal flows slightly differently, and I derive them slightly differently than a deficit, but it's essentially deficit spending. As long as you have sufficient deficit spending, you're going to see essentially a supported financial sector because it's money flowing into the financial sector, and vice versa. When you start to see the public sector, the deficit spending begin to decrease, especially at a very precipitous rate, especially when you get into the situation where you actually get surpluses, you're draining public savings at that point. Okay, so going back to our flow of funds, the federal government issuing essentially money, income through different channels, whether they buy goods and services from business, through say Social Security to households. They're doing that, and that money then goes into private sector savings, and the majority of savings ends up in the financial sector. A lot of that gets funneled into obviously investment vehicles, and then a good chunk of those investment vehicles turns out to be the S&P 500, NASDAQ, Dow stocks. So that's the essence there, okay? One way to look at it, an analogy to look at it, is the fiscal flows are kind of the nutrients that the financial sector needs to continue to have life and thrive. And again, I'm making this important caveat. This does not have anything to do with a real economy. These two things can be separate. Sometimes they can align. Usually they align. But for I'm speaking specifically of the financial sector, for it to be in what we would generally call kind of a bullish environment, where stock prices are rising, it needs those fiscal flows to come. So the easiest thing you can do is, and I'll link to this, is pull up the deficit and watch that. Now, I use the daily treasury statement to essentially get an estimate of the deficit, and I have kind of a way that I've broken down it to get the best estimate out of what the deficit's going to be that's most important for those funds hitting the financial sector. Again, if you want that, check out the Patreon page, patreon.com/KennonMA. But nevertheless, it's this red line that you're going to want to pay attention to ensure that there's necessary fiscal flows to essentially keep the financial sector afloat. But here's the thing, that's just the first pillar, okay? That's the most important thing. We've certainly seen equity growth, stock growth, financial sector growth during periods of decreasing fiscal flows, okay? And we saw that as a good example both during the late 90s and into the mid-aughts before each major financial crisis that we've had in recent times. And so that then leads to the kind of the second pillar that you're going to want want to take a look at, and that is going to be the private sector savings itself. The banking system itself can obviously create debt. Okay, so you can get debt growth, the economy growing through the addition of debt to GDP essentially, and that is going to be best understood through the private debt to GDP that the BIS puts out, the Bank of International Settlements. I will link to these charts below so you can get them as well. But if you want to quickly jump into the Fred series, just type in BIS private debt, and it will be one of the first ones that comes up. So the one of the main, or actually, this is not even necessarily the main pillar of MMT, but it's definitely within the MMT framework. It's that if there's not government spending and the private sector still has a desire to grow as opposed to contract, it's going to do so through more or through endogenous money or bank money creation. Okay, so going back to our chart, and again, if you watch the prior videos, I explained this in a little bit more detail and hopefully flesh some of the details out in those videos. But essentially, households have the ability to leverage up from the money that's in the financial sector. Okay, and this can happen whether or not we can see growth in this, whether or not in this being the private debt to GDP, we can see growth in this, whether or not we're getting the necessary fiscal flows. But it's going to happen and be more unstable in an environment where you have a lack of fiscal growth. But households can leverage up, and at that point, if you continue to see leveraging up, there's a very strong correlation between private debt and the equity space. So if I go ahead and edit the graph here, we're going to change this to percent change from a year ago. Okay, so here's the overall levels that we're at. We're going to go ahead and change this to rate of change from a year ago, and that will show essentially the percent change from a year ago. And we're going to add one overlay to this, and we're going to actually add the Wilshire 500. Did I misspell that? No, I didn't. I did. Wilshire 5,000, and we'll go ahead and add that. Unfortunately, the Dow and the S&P only go back 20 or some odd years, and I want to show the correlation from a further time period. We are then going to go to Format, put this on a different axis, and show the very strong correlation between equity, essentially the equity markets, and the change in private debt to GDP. More importantly, what's very evident, I'm going to turn off the tooltips here. What's really evident as well is you see very sudden decelerations in private debt growth prior to big recessions. Okay, and that's the main signal that you're looking for, right? So this is really then the essence, kind of putting all this together. This is the essence of the trading strategy, and that would be that when you start to see fiscal flows diminish, okay, so when we start getting to a situation where they are not providing the necessary, kind of call it liquidity, but the necessary growth that the economy is demanding, when you're not seeing those flows hit that level and you start to see private debt to GDP really start to tick up and accelerate, that's when you know you're getting into a very unstable environment, and that's when you need to start being very concerned about potential sell-offs that might not recover, right? Because the key is, especially if you're on kind of the slower moving end for trading, you're buy and hold or kind of in that side, what you're looking for is, I'm okay, even sitting through the post-COVID sell-off that we had, right? I'm okay sitting through the 2015-16 sell-off that we had. I'm okay sitting through the early 2018 sell-off that we had. What I want to dodge are the major drawdowns that are that last for a long time, the ones that happened in 2000 and the ones that happened in 2008. And if that's where you're at as a trader, this is the best way to try and ascertain when that might happen. Okay, it's going to be watching the fiscal flows. If those begin to deteriorate, then check out the private debt to GDP ratio and start to see when that rolls over, and that can give you a pretty darn good indication of when there might be some tightening in the financial sector that might ultimately lead to a true business cycle recession. So yeah, that's kind of the essence of the main pillars. Now, unfortunately, the BIS data comes in very late and is oftentimes, by the time you kind of get it, it can be a help. I mean, there's no doubt about it, but it is a little bit lagging just because of how long it takes to gather up by the BIS and then publish. So again, one of the things I've done is try to find kind of the best correlations through data that's published weekly, and then we get a pretty good grasp on essentially what the banks are doing in terms of the risk assets that they're creating. So one more time, the Patreon page is where all that is at if you are interested in that. So the final thing I'm going to kind of point out here too is, at least that I want to touch on, is that if and when we start to see, and this is kind of the big thing that I'm looking for right now, is if and when we start to see a large growth, a sudden reacceleration of private debt, which I think we have seen indications that we're definitely seeing some of that. We're starting to see some acceleration of it. This is when you got to be careful of essentially what's called the Minsky moment, right? Where by virtue of private debt taking up so much of the GDP chunk, right? So if we reset this back to, I'm going to go ahead and delete this line, and we will set this back to just percentage of GDP. When we get closer to, we start, really accelerating, we get closer to the, above the 150, back to the 160, close to the 170. When you start getting to those massive numbers where private debt is just swallowing up more and more of GDP growth, that's when you get very susceptible to this idea of a Minsky moment, okay? Where you really end up chasing asset prices through the avenue of more private debt creation, okay? And that's the scenario that's going to play out at some point that's going to cause another 2000 or 2008 sell-off. So bear that in mind as well. And again, if you want more information, check out Minsky moment on the Wikipedia page. Pretty good, pretty good right up here. And also there's some good videos on the YouTube channel, or on YouTube as well, that can kind of get you on your way to understanding this. But that's the risk from kind of this understanding, is that eventually we'll reach a situation where essentially the creation of new money, new lending is just propping up the market. I don't think we're quite there yet. My overall assessment is, obviously, as I showed just a second ago, we have massive deficits continuing to hit. There are maybe some signs of weakness, some worrisome signs from a kind of a bank flow standpoint. If we look at it back from the flow of funds, maybe some household deleveraging might be occurring. Too soon to tell at this point. That might be on the horizon, but as a whole, the fiscal flows are so strong right now that ultimately, at least in the next 6 months or so, I don't see us getting a true business cycle recession. That can change, policy can change. I mean, a lot can change in a very short amount of time. But for right now, I think we're going to continue in a situation where we see a relatively volatile market, big moves like we've seen in recent days. But ultimately, we will likely continue to see dips get bought and ultimately kind of higher highs in the equity spaces based on my analysis as of September 9th here when I'm recording that. So that's pretty much it. That is kind of how I trade on the basis of MMT, that idea that private sector savings is equal to public sector money, that the deficit is the money that is in the financial sector, and as that deficit continues to grow, you will see a growth in the financial sector, and a lot of those flows, a lot of those funds flow into the equity space, and you get a very propped up equity space. Now, with that being said, there are a lot of things that you can build upon that overall process, right? There is, I'll look at things like sentiment, I'll look at things like momentum, the implication of volatility, options, dealer position. positioning and their gamma exposure, other correlated assets, and then over on top of all of that, add on technical analysis. So if you're a more active trader, those are the sort of things you're going to look at and build upon this kind of base case for MMT. But this is it. This is how I've traded over the last 3 some odd years, and at least publicly in terms of what I've done here on the YouTube channel and on my Patreon page. I've going on about 3 years now, publicly posted every trade I've made. And on my Patreon page, I post my, right on the landing page, I post my historical performance, updated every month. And it's definitely, I mean, it's paid off. I certainly use a fair share of leverage to obtain this, but for the most part, it's been able to keep me on the long side during this run up and get me out of the way of the major sell-offs. So I do think there is some value to pay attention to this understanding of how markets work, and I think it has certainly proven itself quite effective over time. So yeah, that's it. That's the basis of trading with MMT, and how I really think you can get an edge up on the markets as a whole with just kind of 2 of the main pillars of MMT. So I'm going to go ahead and wrap things up here for this update. So yeah, if anyone has any questions, leave them in the comments below. And if you are new here and you haven't yet hit subscribe, make sure you do that. Hit that subscribe button and then turn on that notification bell as well. It'll make sure that whatever device you're logged into will get a notification every time I post a new video, so you won't miss any of that. And then if you found this video specifically helpful, by all means, give it a thumbs up. It'll help the YouTube algorithm so more people can check it out. And yeah, like I've said a few times, if you're an active trader, active investor, and this is something that really interests you and you want to find out more, check out my Patreon page, patreon.com/CannonMA. Otherwise, I'm going to leave it there. Good trading, everyone. And yeah, we'll see you next time. Bye-bye.